Welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to have you all here.
You know, if you're thinking about diving into real estate investing, one of the most crucial things you can do is have a solid due diligence checklist. It's like your safety net, right?
Exactly, Sarah. It's essential for making informed decisions, especially if you're looking to build long-term wealth.
So what can our listeners expect from us today?
We're going to break down the key elements of that checklist. Things like property inspections, market analysis, and financial assessments.
Yeah, and we'll share some personal stories and tips that have helped us in our own investing journeys.
For sure. I think those real-life examples can really resonate, especially for those who might be feeling a bit overwhelmed.
Absolutely. And we want to make sure you leave with actionable insights that you can put into practice right away.
So whether you're just starting out or looking to refine your strategy, stick with us as we dive into these important aspects of due diligence.
Let's get into it.
You know, Sarah, the reason due diligence is so crucial, especially for investors over 40, is really tied to our timelines. I mean, many people in this age group are thinking about retirement, whether it's just a few years down the road or a bit longer.
Absolutely, Mike. And with retirement looming, the stakes feel higher, right? You want to make sure your investments are solid because they're not just about making money. It's about securing a comfortable future.
Exactly. And with inflation creeping up, it's even more pressing. If you're relying on fixed incomes like pensions or Social Security, you really need your investments to be working hard for you to keep pace with living costs.
Right. I've heard from listeners who worry about that, especially when they see prices rising everywhere. They want to ensure that their properties are not just maintaining value, but actually appreciating over time.
You know, I had a client, let's call him Tom. He was in his early 50s when he came to me. He had a couple of properties, but he hadn't really done his homework on them. When we went through a due diligence checklist together, we discovered that one property was in a neighborhood that was declining.
Oh no, what happened there?
Yeah, it was tough. Tom had bought it thinking it was a great investment, but he hadn't considered upcoming developments or changes in the area, which were really impacting property values. We helped him sell it before it lost too much value, but it was a lesson learned.
That must have been a wake-up call for him. So doing that research beforehand could save a lot of heartache later on.
Definitely. And it's not just about the money, you know? It's about peace of mind. When you're investing for your future, the emotional side of financial security is huge. You want to feel confident that your money is working for you, not against you.
Yes. And for folks over 40, many are also thinking about wealth transfer to their families. They want to leave a legacy, right?
Exactly. I met another investor, let's call her Linda, who was really focused on that. She wanted to make sure her properties would be a nest egg for her kids, but she hadn't really planned for how to manage them if something happened to her.
Oh, that's such an important point, Mike. Planning for the future isn't just about the current investments, but also about how to pass them down, right?
Yes, and that's where due diligence helps too. It's not just about being reactive. It's about being proactive and thinking ahead. If Linda had a solid plan in place, including all the necessary documents and understanding of her properties, her kids wouldn't have had to deal with a mess later on.
That makes so much sense. And with the current economic trends, we're seeing shifts in the market that can be both opportunities and challenges, right?
Absolutely. We're in a time where interest rates are fluctuating, and this can impact buying power. It's more important than ever to be on top of market conditions. And that's where due diligence really shines.
Right. And for someone like Tom or Linda, knowing the market trends can help them make informed decisions about when to buy, hold, or sell.
Exactly. And let's not forget about the emotional aspects too. Investing in real estate can be stressful, especially with everything going on in the world. If you've done your due diligence, you can feel more secure in your choices.
Yeah, it's like a safety net. Knowing you've done your homework can help ease those nerves.
For sure. And consider how many people are feeling uncertain about their jobs or the economy right now. Having a solid investment strategy can alleviate some of that anxiety. You want to feel like you have control over your financial future, not just letting it happen to you.
I love that perspective. It's empowering, right? And I think it's also about adapting to changes, like the rise of remote work, for example.
Yes! That shift has changed the way people look at different markets. Areas that weren't traditionally viewed as prime real estate are now becoming hot spots because people can live anywhere.
So for those over 40, it's about being aware of these trends and how they affect your investments.
Exactly. And if you're feeling overwhelmed, just take it step by step. A thorough due diligence checklist can be your guide, helping you navigate these changes.
And it's not just about the numbers, is it? It's about creating a life you want to live and ensuring that your investments support that.
Yes, investing should enable your lifestyle, not limit it. Making informed decisions through due diligence means you can focus on what truly matters to you, like spending time with family or traveling.
So Mike, it sounds like understanding your due diligence process isn't just a nice to have, it's a necessity, especially in today's climate.
Absolutely. And I think it sets the stage perfectly for diving into some core strategies. We can break down what that checklist looks like and how to approach it effectively.
Sounds great. I'm excited to get into the nitty-gritty of it. Let's do it.
So let's dive into the due diligence checklist every investor should have, right? It's super important, especially for those looking to build wealth over the long term, which is what we're all about here.
Absolutely. Where do you think we should start?
Well, a good starting point is the basic financial metrics. You know, the 1% rule is a classic one. It suggests that the monthly rent should be at least 1% of the purchase price.
Right, so if you buy a property for $200,000, you're aiming for $2,000 a month in rent?
Exactly. And it's a quick way to gauge if a property could be a good investment. But of course, it's not the only metric you should consider.
What's another one that you'd recommend?
The 50% rule is another handy guideline. It's kind of straightforward. When you're calculating potential cash flow, assume that about 50% of your rental income will go towards expenses.
Oh, that makes sense. So if you're pulling in $2,000 a month, you'd estimate $1,000 for expenses?
Yep, that's the idea. So if your mortgage is, say, $1, $200 a month, you'd be looking at a cash flow of negative $200. Not a great position to be in, right?
No, definitely not. And that's where a thorough evaluation comes in. What about cap rates?
Cap rate is a key metric for evaluating the potential return on an investment property. It's calculated by dividing the net operating income by the property's purchase price.
Can you break that down with an example?
Sure. Let's say you have a property that generates $30,000 in annual rent. After expenses, you have $20,000 left, which is your net operating income. If you purchased the property for $200,000, your cap rate would be $20,000 divided by $200,000, which gives you a cap rate of 10%.
Wow, that sounds pretty good. So you'd be looking for properties with a higher cap rate, right?
Generally, yes. A higher cap rate usually indicates a better return, but you also have to consider the risk involved. Higher returns can often come with higher risk.
So there's a balance to strike there. What about the types of properties?
Good question. Single-family homes are often a great entry point for new investors. They tend to be easier to finance, and there's usually a larger pool of potential renters.
And I know multifamily units can be appealing too.
Exactly. Multifamily properties can provide a better cash flow because you have multiple tenants, but they also come with more management responsibilities.
Right, and speaking of management, what about the financing options?
Well, traditional mortgages are a common route for financing, but there are alternatives like hard money loans for quicker access to cash.
Hard money loans? Those can be risky though, right?
They can be. They usually come with higher interest rates and shorter terms, but they can be useful if you're flipping properties or need to move fast.
That makes sense. So for the due diligence checklist, you'd want to consider your financing options right from the start.
Absolutely. And then once you've got your financial metrics in mind and know the type of property you want, it's time to evaluate the deal itself.
What do you mean by evaluating the deal?
Well, you should have a checklist for that. Start with the property condition. Are there any major repairs needed? You might want to hire a home inspector to get a clear picture.
That's a smart move. What else?
Check the local market trends. Are property values rising? What's the rental demand like?
So understanding the market is crucial.
Exactly. And then consider the property's location. Is it near schools, parks, or public transport? Those factors can significantly impact rental demand.
And don't forget about zoning laws, right?
Right. Make sure you know how the property is zoned. You don't want to buy something thinking you can convert it into a multifamily unit, only to find out it's zoned for single-family use.
That would be a bummer.
Definitely. And then there's the financial side. Run the numbers. Look at projected cash flow, potential appreciation, and any tax benefits you might be eligible for.
So much to consider.
Yes, but it's all about making informed decisions. Another tip is to connect with local real estate groups or online forums. Real insights from other investors can be invaluable.
Community support can really make a difference.
Definitely. And you should also consider working with a real estate agent who understands investment properties. They can help you navigate the process.
Sounds like a solid plan.
And don't forget to factor in potential exit strategies. What's your plan if you need to sell? Understanding your exit strategy from the beginning can save you a lot of headaches later.
That's a great point.
It's easy to get caught up in a deal and overlook these critical steps.
Speaking of overlooking things, what common pitfalls should investors be aware of?
Well, that's a big one. Sarah, one of the biggest pitfalls I see investors fall into is over-leveraging. They get so excited about a deal that they stretch their finances too thin.
Yeah, it's tempting, right? Especially when the market seems hot. But that can lead to a lot of stress down the line.
Exactly. I had a client, let's call him Tom. He found this property that was a great deal on paper. He took out a huge loan, thinking he'd cash flow like crazy. But things didn't go as planned.
What happened?
Well, the neighborhood started to decline, and he struggled to find tenants. The rent he was expecting just didn't materialize. He ended up having to cover the mortgage out of pocket.
Ouch. That's tough.
Right? And because he was over-leveraged, he didn't have much room to maneuver. If unexpected repairs came up, or if his tenants defaulted, he was in a really tight spot.
So what's the lesson there?
Always assess your financial limits, It's crucial to have a buffer. Ideally, you want to keep your debt-to-income ratio in check and ensure you have enough savings to handle unexpected situations.
Yeah, and I imagine that leads us to another common mistake. Not properly screening tenants.
Absolutely. Bad tenants can turn an investment into a nightmare. I once worked with a woman named Lisa who bought a duplex thinking it would be a great income source. She didn't do her due diligence on her tenants.
Oh no. What happened?
She ended up with a couple who paid the first month, then just stopped. They didn't care about the property either. By the time she evicted them, she had racked up thousands in unpaid rent and damage costs.
That's heartbreaking. I guess it's vital to really vet potential tenants. Credit checks, references, the whole 9 yards.
Exactly. And trust your instincts. If something feels off during the screening process, it probably is.
And then there's cash flow, right? Ignoring it is another big mistake.
Definitely. I've seen investors get so caught up in the property's potential appreciation that they overlook cash flow entirely. It's like they're just waiting for prices to go up without considering the monthly expenses.
Right, and that can lead to some very uncomfortable situations.
I had a friend. Let's call him Mark. He bought a property in a trendy area, thinking he'd flip it in a year. But, he didn't factor in things like property management fees, maintenance, or even vacancies. When expenses hit, he was left scrambling to cover his cash flow.
I can imagine how stressful that must have been for him.
Totally. He realized that even if the property appreciated, if he couldn't cover his costs, he was in trouble. The market fluctuates, but monthly expenses are a constant.
So what's a good rule of thumb for cash flow?
A good rule is to aim for a property that brings in at least 1% of its purchase price in monthly rent. That way, you have some cushion for expenses.
That makes sense. And then there's the issue of timing the market, right?
Yes! Timing can be tricky. Investors often think they can predict market movements, but that's not usually the case.
I've heard stories about people just waiting for the perfect moment and missing out.
Exactly. I remember a couple, Jake and Emily, who waited years to buy, thinking prices would drop. They kept telling themselves they'd get a better deal. In the end, they ended up paying much more for a similar property later.
So what's the takeaway here?
Don't try to time the market. Focus on finding a solid investment that fits your criteria and your financial situation. Markets will fluctuate, but a good property will always have value.
And let's not forget about hidden costs. Those can really catch you off guard.
Oh, for sure. It's easy to overlook things like property taxes, insurance, maintenance, and even homeowner association fees. I had a client, let's call her Susan, who was so excited about her new property that she didn't account for those additional expenses.
What did she miss?
Well, she bought a lovely condo, thinking her mortgage was the only payment she'd have to make. But then she got slapped with a hefty HOA fee and unexpected maintenance costs. It really ate into her cash flow.
That sounds frustrating.
It was. She had to adjust her budget significantly. So always do your homework on all potential costs, not just the mortgage.
So how can someone spot these red flags early on?
Good question. A thorough due diligence checklist is essential. Check the neighborhood trends, look into property management options, and always analyze the numbers. If something feels off, dig deeper.
And I imagine asking for a second opinion can help too?
Absolutely. Having another set of eyes on your investment can provide valuable insights. Whether it's a trusted advisor or a peer, don't hesitate to reach out.
So in summary, it's all about being proactive, right?
Yes. By understanding these common pitfalls and taking your time with due diligence, you can set yourself up for success. It's not about rushing into a deal, but rather making informed decisions.
That's such a great perspective, Mike. It really emphasizes the importance of preparation.
Exactly. And for those who might have encountered some of these pitfalls, it's never too late to adjust your strategy. Learning from mistakes is part of the journey.
Definitely. And that's a reassuring thought for anyone feeling overwhelmed out there.
Right. Just remember, every investor faces challenges. It's how you respond that truly matters.
And with the right mindset and preparation, you can bounce back stronger than ever. What a great way to wrap up this conversation.
Absolutely. On to the next steps for our listeners. All right, so let's dive into some immediate steps that our listeners can take today, right?
Yeah, absolutely. I mean, it can feel overwhelming, but breaking it down into actionable steps makes it so much easier.
Exactly. One of the best ways to start is by creating a due diligence checklist of your own. Just list out the key areas you want to investigate when looking at a property.
That sounds super helpful. What should be on that checklist?
Well, first I'd recommend starting with the basics: property condition, neighborhood analysis, and financial metrics. You could include things like checking the roof, the plumbing, and any potential repairs that might be needed.
Right. And don't forget about the neighborhood. What's the vibe like? Schools, amenities, crime rates.
Yes, and all that can impact your investment long term. I'd also suggest checking local market trends. Zillow is a great tool for that. You can see property values over time and what homes are selling for in the area.
Oh, definitely. I love Zillow for that. It's so user-friendly. What about analyzing the numbers?
For that, I'd recommend using tools like the Bigger Pockets calculator or Deal Check. They can help you run the numbers on potential cash flow, ROI, and other important metrics.
Those are great resources. And for those who might be looking to rent out their properties, what do you think about Rentometer?
Rentometer is fantastic for quickly assessing rental values in a given area. You just enter your address and it shows you comparable rents. Super handy.
And for someone just starting out, how about local MLS access?
Absolutely. Having access to the multiple listing service can give you a deeper insight into properties that might not even be on the public sites yet. You can find hidden gems that others might miss.
That's a great point. It's all about staying one step ahead.
Exactly. And for a more hands-on approach, I'd suggest setting a goal to analyze at least one deal per week. It doesn't have to be a big deal. Just something to get you in the habit of evaluating properties.
I love that idea. It's so manageable, and it keeps you engaged in the process.
Right, and joining a local real estate meetup can also be invaluable. It's a great way to network, share experiences, and learn from others who are on the same path.
Yes! Meeting people who are already investing can provide insights that you just can't get from a book or a podcast.
Speaking of books and podcasts, I'd highly recommend The Book on Rental Property Investing by Brandon Turner. It's got tons of practical advice for beginners.
That sounds like a must-read. And what about podcasts?
I'd say check out the Bigger Pockets podcast. They cover a wide range of topics and often feature interviews with successful investors. It's super motivating.
That's perfect for anyone looking to get inspired. And, what about starting small with your investments?
Great question. You don't have to jump into a huge property right away. Maybe consider starting with a duplex or a small single-family home, just something manageable to begin with.
Yeah, and you can learn so much from that first investment. It helps build confidence for the next steps.
Absolutely. And remember, starting where you are is key. Every little bit counts, and building those habits will pay off in the long run.
So true. It's all about progress, not perfection, right?
Exactly. And, as you develop these habits, you'll find that your knowledge and confidence will grow, making it easier to tackle bigger investments down the road.
I think that's such an encouraging message. Just take it one step at a time.
So with these tools and habits in your pocket, you're ready to move forward. Let's recap what we've covered today. Well, as we wrap up this episode, let's recap some of those key takeaways from our discussion on the due diligence checklist.
Yeah, definitely. First off, I think the importance of location really stands out, right? You've got to know the neighborhood, what's happening there, the amenities, schools.
Absolutely. And then there's the financial analysis. Understanding cash flow and expenses is crucial. It helps you make informed decisions and avoid nasty surprises down the line.
Right, and don't forget the importance of inspections. A thorough inspection can save you a ton of money and stress. You want to uncover any hidden issues before you commit.
For sure, and we talked about the significance of understanding local laws and regulations. Being aware of zoning laws can really protect your investment in the long run.
Exactly. And finally, building a reliable team. Having a good real estate agent, a strong attorney, and a knowledgeable inspector. That support network is invaluable.
It really is. And when you take these steps seriously, you're not just chasing after properties, you're building a solid foundation for long-term wealth.
That's such a great point, Mike. Real estate investing can be an incredible journey, especially for those of us over 40. It's never too late to start building that wealth.
And remember, if you found value in today's episode, please like, subscribe, and share your biggest takeaway or any questions in the comments. And if you know someone over 40 who's thinking about investing in property, share this with them.
Next time, we'll dive into title and escrow red flags to avoid. That's going to be super important for anyone looking to navigate the buying process smoothly.
So, until then, take care and happy investing.
Thanks for joining us. We'll see you next time.